All right, it all comes down to this. Some have called this the most important quarter for Microsoft. I don't know about that, but it certainly will come with fireworks, not just for Microsoft if you're a shareholder, but the broad market, because these tech giants that are reporting this week make up such a big chunk of the S&P 500. We'll get earnings perspective and what to expect with Gil Luria of D.A. Davidson. He doesn't drink the AI Kool-Aid fully. He's probably one of the most bearish analysts there is out there on NVIDIA, for example. So he's choosing his spots in AI. He's also going to come up with three names you probably never heard of in the tech space if you want some out-of-the-box thinking. So that's coming up at 11:30 a.m. Eastern Time. Sticking with tech, Celestica, which manufactures electronic components and certainly does play big in AI. It sells things to those hyperscalers like Amazon Web Services, like a Meta, like a Microsoft with its Azure. And that's doing just well for it. Thank you very much. In its most recent set of quarterly results, beating expectations, the outlook is better. Paul Bagnall will talk about those results in detail. Now, let's take a look at the broad market action. We've got sort of this trifecta of catalysts in front of us. We've got tech earnings. We've got a Fed rate decision. And then we have something that might seem like a yawner, but was a real catalyst for the market rally yesterday. And that is the U.S. Treasury Department issuing an update saying they don't expect to borrow as much as perhaps the market had expected. Tomorrow, they're going to update the market on how much they expect to issue with respect to Treasury bills and bonds. That might seem like a snoozer, but look at this chart. The last time they updated the market was November 1st. That marked the bottom for stocks. That also sent yields rallying. So could be, out of the three, one of the more important things to focus on. Let's bring in Ross Mayfield, investment strategy analyst at Baird, for some perspective. Ross, can we nerd out on Treasury issuance for a second? How are you thinking about that?
Yeah, I think it's really important, right? There's this question of Treasury supply on the market, and it's been a weight on yields at certain points, or on bonds, I should say. I think not just the amount, but the mix of bills versus bonds is going to be really important. The Treasury has resorted to funding at the short end of the curve, despite higher interest rates, to keep long-term yields kind of in check. So I think the mix of bills and notes and bonds is going to be really important, as well as the overall level. As you mentioned, it may not have been the only thing, but it was one of the things that marked the bottom back at the end of October. And increasingly, the market is concerned or worried or thinking about the moves in yields. So something to watch.
Something to watch. It comes out at 8:30 tomorrow morning, so that's a catalyst. So too will be the Fed rate decision. We just got a rate of job openings in the United States that suggests it's still a tight labor market. There's more than 9 million job openings in the United States, as the unemployment rate currently sitting, and we'll get an update of this, but the unemployment rate currently sitting at around a 3 handle. The Fed has to think about this, right, in addition to inflation tomorrow.
Yeah, absolutely. I mean, look, their main points of concern from here are wage inflation and rent, housing, shelter inflation, however you want to define it, those kind of core services pieces of inflation. And so if the labor market is not cooling off in the way that they need it to, and if wage growth stays high because there are so many job openings and such demand for labor, then it's something that has to enter their calculus. Now, I think there's enough else going on in the economy that will allow them to continue on the path that they've kind of laid out, which is a handful of cuts this year as inflation returns to target. But anything that would put upward pressure on wage inflation is going to catch their attention. And any sign that the labor market is not cooling off, but maybe rather reheating, is going to catch their attention as well. How
do you think it plays out? Is the Fed going to push back on market expectations on the magnitude of the rate cut, or has that already taken place, right? The odds of March are now way below what it was when we walked into the year.
You know, I don't know how much insight we'll get tomorrow in particular. I think if you got a moment of truth with Chair Powell, if you asked him if he thought they would cut rates 5 to 6 times this year, as the market is implying, he would probably say they'd be aiming for something a little bit lower, simply because of the strength in the economy. But I do think that they'll tweak their language to remove kind of the tightening bias, right? And then the presser has been where all the action has been, kind of the tone and tenor of Chair Powell, how dovish versus hawkish are his words interpreted as. And I think that they'll continue to lean dovish. They probably don't like when the market front runs them and rallies on the idea that they might pivot. But at this point, real rates are rising. Core inflation is back near their target, and the economy has remained resilient. So at this point, they've basically achieved their soft landing. They just have to not fumble the ball on the 1 yard line.
Let's talk market concentration. We have lamented about it, the significance of the Magnificent Seven, and how much of the market, 25%, that they make of the S&P 500. We'll get into them as a group and whether they're sort of investable here. But for investors, whether you want to or not take a look at them on a fundamental basis, if you're tracking the index, they matter.
Yeah, they matter as much today as they ever have before. And so to your point, their earnings matter, what kind of businesses they're in. It all matters because when you're a company that's 7-8% of the index, when you're a group of companies that are, playing in the same space and are up to 25% of the index, any little move is going to matter more than the 10 energy names down the cap scale might. So investors, especially passive ones, but even ones who are invested in active managers who track them as a benchmark, these things matter more today than they ever have before because the concentration is pressing up to those .com bubble levels and is really as high as we've seen it.
Does that create a positive feedback loop into the sector? The more you have to pay attention, the more you can't afford not to be allocated to them?
Yeah, probably to an extent. And the more dollars are allocated to passive investments, the more go into them without necessarily thinking about the fundamentals. Now, it's not something that, concerns me in particular. It just is a fact of life for this market. High concentration has not portended, worse or better forward returns. It just kind of is what it is. But at a certain level, you do start to think about it and you wonder if it is sort of a feedback loop that can ever be broken. They're going to, at some point in some of these products, hit some of the diversification limits of a registered investment company. I think that'll trigger some rebalancing and some reshuffling of things, but we're not at that point yet. And as you mentioned, we're kind of just along for the ride here.
Because they suck up so much oxygen. There was a stat that kind of smacked me in the face from FactSet that added up the earnings potential of the Magnificent Six, we'll call it, leaving Tesla out, that they make up for aggregate earnings year-over-year growth of almost 54%, while the rest, the 494 earnings, blended earnings expected to fall 10.5%. So not only are they driving the index, they're driving the earnings growth as well. As you look to those, 490 that are being left behind, are you finding opportunities? Is there an unloved sector area of the market that you think investors should pay attention to?
Yeah, absolutely. So first on the former point, I would just say, there's a lot of anxiety about the concentration in these names, but at the very least, they are bringing earnings to the table. Yeah. If you look at the .com bubble as the comparison, there was not necessarily the cash flow and earnings to back up the market cap or the valuation of those companies. At least today, for better or for worse, these companies bring earnings and cash flow and low debt to the table. And so at a minimum, there's a quality bias there, I think. As far as unloved, certainly the industrials and financials have been two of the better performers since that November 1st low. I would look at some of those value sectors, particularly those two. Industrials have been a favorite of ours for a while now. They kind of quietly outperformed at least some of the other value sectors in 2023. They have a lot of kind of secular structural tailwinds in the form of big fiscal spending, aerospace and defense uptick in spend. And then if we get this global soft landing, a lot of the more cyclically oriented sub-industries there could catch a bid. So definitely like the industrials here as a place to go outside or a place to diversify away from that big tech exposure.
Ross,